Good afternoon, everyone, and it is another good afternoon for the stock market. Any market you want to pick, it's a good day for the markets, all of them. Dow Jones Industrials heading up to its highs of the day, just reached its highs of the day so far, up 400 points. It's crazy, isn't it? S&P up near its highs of the day, it's almost 1%, and the NASDAQ composite up 0.9%, up 87 points today. Just a stunning day. Follow-on momentum from Friday, follow-on momentum from the week that saw the Dow rise more than 6%, just crazy numbers. And follow on from the market rally that started off of the March 23rd low. So we'll get into a little bit of what's driving that, and we'll get a little bit into what's good and bad about the rally and the prospects for it continuing. I'm not going to have a date for you on that, but I'm going to have a time frame, and we'll see how close we come to prognosticating what might happen. And speaking of what might happen, I want to talk about the Fed meeting on Wednesday. We're going to find out whether there are going to be changes in the Fed policies. I don't believe there will be. We know the Fed is going to keep rates lower for longer. The question really is there anything that could come out of the Fed meeting whereby the Fed backs away from any of the stimulus that is provided, any of the liquidity that it has provided? That's a pretty big question. Most people don't believe that there's anything like that going to happen. I don't believe it. They've come this far. They love the markets rising. They know there's irrational exuberance going on. There's no question about that. But at the same time, this is what they've engineered. So be it. So moving on into the close, I want to talk briefly about bonds. We talked the other day about bonds, and I sort of said, beware of the bond market, keep an eye on it, because not all is well and good there. And that though the Fed may want and will try with everything in its power to keep rates lower for longer, there is a chance that the bond vigilantes will get up in arms and push back, and rates might rise. The bond market has the capacity to fight the Fed. Generally, the Fed will overrule whatever the bond market, whatever the bond vigilantes expect to be able to do. And what the bond vigilantes are, they're a group of guys that basically traders and big time traders who don't agree with Fed policy, and their actions are to essentially try to not buy treasuries, to kind of push down on bond prices, to lift yields, because they believe that the Fed has kept them down too low for too long. Their power over the years has diminished because traders are essentially self-interested, and it's pretty hard to go against the Fed. So while that happened in the 80s and the 90s, it's much harder to pull off now. It doesn't mean that rates can't rise. Last week was pretty crazy. Last week, in terms of the bond market, just to let you know how out of control things are becoming, the bond market on Friday, the 10-year dropped. I should say, well, the price drop, but I'll talk in terms of yield. The yield rose from 0.85% to 0.93% on Friday in that huge risk-on rally where folks were dumping treasuries because they were putting money to work in the stock market. That's a 9.4% drop in a day. All right, to add a little insult to injury, the 10-year closing at 0.93 on Friday. I'm not sure if it closed there. I know it traded there. It may not have closed quite that high in yield. Rose from 0.65% the week before. So from 0.65% yield to 0.93% yield in a week. That's a 43% increase in yield. That's devastating in terms of dollars and cents, in terms of trading. The bond market is going to be the first place we're going to see some serious devastation if the stock market doesn't beat it to the punch. And there's a chance that it could. So let's just go through some of the things that are interesting to say the least, and worrisome also in the least. And in particular, I want to talk about some of the metrics from last week, and that would be the Dow Jones Industrials rising 6.8% on the week. Now, that's half of a good year right there in a week. So 6.8% in a week. The S&P was up 4.9 cents, 5% in a week. Again, long-term averages roughly around 10 to 12%, depending on which monikers, not monikers, but which metrics you use, Ibbotson or some of the other calculations, between 10 and 12, and some lately, if you use just really the modern era by that, I mean the last 10 years, you're closer to 14%, but still, so 5% on the S&P in a week is insane. NASDAQ Composite 3.4% in the week. So to me, it's all good until it isn't. And here we are coming into the close with a little more than a little less, I should say, than 9 minutes to go. And the Dow is just pushing higher. S&P seems to be pushing higher. Everybody's pushing higher. NASDAQ Composite joining. Russell moving higher for sure, but not quite as robustly as the others. So meantime, we saw oil tick down today, which was interesting because Saudi Arabia talked about a 1-month extension of oil cutbacks in production. Now, why the market would falter on that probably is a sign that nobody cares. Because what difference does 1 month of production cuts make in the long term? So the market's probably looking for something more, expected something to be of some merit in terms of oil prices rising. They got up to close to $40 and WTI, and they're just kind of pushing towards that level. And then we're back down to 38 and change, I think, today. I haven't looked at it in about a couple of minutes, but we'll find out where it's trading. But here we are coming into the close, 8 minutes to go, and just another risk on day. And you have to ask yourself, with the NASDAQ Composite making an intraday all-time high on Friday and closing today at another all-time high, how long this can last. And the Dow, the S&P, not far behind. They've got a little more to make up before they get back to their all-time high, but they're certainly heading in that direction, and doesn't seem to be a lot out there to stop them. So with that being said, I want to talk about irrational exuberance. Are we experiencing irrational exuberance? Is this irrational exuberance? Are the markets moving too fast? Are our valuations out of control? Are we headed for some kind of backup? Are we headed for a crash? Is this the irrational exuberance that we saw heading into the tech wreck? And so for those of you who remember the tech wreck and remember the irrational exuberance phrase, and those who didn't, let me just remind you that in December of 1996, then Federal Reserve Chairman Alan Greenspan spoke of the irrational exuberance in the market because the tech stocks were just tearing up the market. Then NASDAQ ended up going from about 1,000, NASDAQ Composite that is, to over 5,000. That's between 1995 and 2000. So while Greenspan's irrational exuberance comment came in December of 1996, it was years before the market topped out and turned around and crashed. And when it crashed, it did crash. So just for some perspective, because we don't think sometimes when things are feeling good and looking good that these things can happen again, they do have a tendency to repeat themselves for good reason. Between 2001 and 2002, stocks that the NASDAQ Composite that had peaked at 5,048 fell to 1,139. That's a 76.81% drop. 77% drop from the highs to the lows. It took everything down with it, including Intel and Oracle and some of the big name stocks, Cisco. They're all great companies making good money, all got hammered. They were all down 80% in the tech wreck. So it took the NASDAQ Composite 15 years to recover its former high ground. So that's how bad things can happen and how bad they can get. Are we moving into a period of irrational exuberance? Yes, absolutely we are. Can it continue? Yes, it can. Can it continue for years? No. Can it continue for months? Yes. A couple of quarters? Yes. Is it going to continue for a couple of quarters? Possibly. I'm not sure. But things are happening so fast now, they're happening at light speed, that I don't know that we're going to see 3-4 quarters of this irrational exuberance. I think we're already getting to a point in terms of valuations where people are going to start to question the valuations. In terms of valuations, in Barron's on Saturday, read a great article. The head of Luthold Group did a study, and he found that the top 25 stocks in the market, top 25% of stocks in the market in terms of performance from 1950 to last week, the top 25% of performing stocks had back in 1950, and these are the shall we say, fattened up, beefed up PE stocks, had a average PE of 26.3. Again, these are the stocks that people were chasing. All right. As of Friday, the top 25% have an average PE of 38.3. Okay. Talk about richly priced. Back in 1950, the remaining 75% of the market had a PE of 13.2. Now that 75% has a PE of 14.2. So there's a huge disparity between the haves and the have-nots. Huge. So if you're thinking in terms of PE multiples, and this is one of the ways that people look at the valuation of stocks to decide whether they're paying too much for a stock, and you're looking at their earnings and you're looking at the price you're paying for those earnings. They're getting rich. Talked the week before last, talked about another report that I had read that said that the top 10 stocks in the NASDAQ composite had an average PE of just over 29. That's rich. While the rest of the market, the more than 2,600 stocks, had an average PE of around 14. So huge disparity between the haves and the have-nots. So we're seeing a lot of this irrational exuberance. Now we're seeing that move out of some of the mega cap tech stocks into anything else that's been beaten up. So we're seeing airlines and cruise lines, and we're seeing industrials, and we're seeing manufacturing, and we're seeing autos, we're seeing banks, we're seeing everything that's cyclical, everything that had been beaten down and left for dead is now getting very healthy bids. Why? Because bargains doesn't justify, and the PEs on them are rising much larger and faster than they actually are. I'm talking about that group that's now getting bid up. Those PEs are rising because of the price increases in those stocks relative to their earnings. But don't forget, these companies don't have any earnings. The airlines don't have any earnings to speak of. Cruise lines they don't have any earnings. Okay, so people are now willing to pay some rich multiple for companies that don't even have earnings, cannot certainly ascertain what their earnings might be or how they might grow those earnings, and whether or not they will return to profitability in a year or 2 or 3 or the 12th of never. So starting to get irrational. Again, we can continue in irrational exuberance mode for some time to come, but the way this market is moving and the rapidity with which stocks just keep climbing is unprecedented and getting to be irrational. So I just want to put that out there because I'm looking at the bond market, and if the bond market starts to back up and the stock market sees that, the stock market's going to get a little worried about inflation, though we know it's far down the road. There is inflation in some things, in foodstuffs, and some other areas we are seeing inflation. I'm sure not seeing it in apparel or energy right now or some of those other areas, but we are seeing some signs of inflation. And inflation can rear its ugly head at any time. The Federal Reserve has no idea. They believe inflation is dead, and they're talking about the 2% rate that they want to get to, which is an absolutely made up number. 2% inflation rate, and this is sort of a global central bank number, is completely dust. It's fairy tale dust. It's a made up number. There's nothing magical about 2% inflation. Nothing. So why did they pick that? Because they knew we would never get there. after the financial crisis. It was impossible to get there, given the devastation, demand devastation of the financial crisis, given a lot of metrics and a lot of things that happened during the financial crisis and then afterward during the Great Recession, and the way globalization has occurred, that we were not going to get to see 2% inflation. So why did they pick that? So they can continue to keep interest rates lower for longer. Okay, so there you go. So that's is as far as irrational exuberance goes. Just keep your eyes open. I'm not worried about this market turning tail like that. I think we're going to have forewarning. We certainly had forewarning when the market started and wanted to go up. The absolute turn between March 23rd and 24th was certainly no signal. I didn't see a signal there. It completely caught me by surprise. And the move was just another one of those volatile moves that we were seeing in the last few weeks prior to that. So what happened thereafter, within a week, all of a sudden it was pretty clear that the market looked like, no, we want to go. The shorts had to cover, and on and on and on. It continued to go. The shorts kept powering the first half of the rally off of the lows. The shorts really were the power train that pushed the market forward. Then it became the rest of FOMO, the fear of missing out, and the TINA, there is no other alternative. And you have institutions and you had retail. Now, really, what worries me was not prior to the fact that retail was getting in, the fact that now the retail is driving the bus. Gotten to a point where that's a little irrational. So a lot of really crazy retail metrics. Hundreds of thousands of accounts have been opened since this year, in the beginning of this year. Hundreds and hundreds of thousands of new accounts. And because a lot of the folks can now trade commission free and can buy fractional shares, they're out there putting their hard-earned stimulus money and whatever money they have into the market, and they've done very well. It's great, but we'll find out if the market starts to turn tail, whether or not those folks who are relatively new are going to stick around, whether they're the passive investing crowd who's happy, but they're not. There are certainly a lot of passive investors that have come on board, but there's a lot of active investors, a lot of active retail traders who have chased up specific sectors, specific stocks, and we'll find out if they are close to losing some money or close to thinking that they may lose, or wondering, hey, this thing could turn around just as fast as it went up. Will they sell? Will the retail crowd that's really pushed the market up be the crowd that steps all over the rally? Remains to be seen. But I think we're going to get some heads up. It's not going to happen overnight. It'll happen over a couple of days. We'll start to see some weakening, and we'll get ready for it here. I just want to bring that up because I'm starting to see things now that just, again, are irrational, don't make sense, doesn't mean they can't continue, and we're just going to go with it right now. Let's just enjoy the ride. Maybe like I think it's a Grateful Dead song, maybe going to hell in a bucket, but at least I'm enjoying the ride. So let's just enjoy the ride until something happens, till somebody hits the brakes, or until we hit a wall. And then we'll act accordingly. Got a bunch of questions here, then we'll just close up the market here. Adrian's asking, so it's confused me, as I thought SDS and hedges like this were for the long term. Yes, and that's a great question. The ultra short stuff is, the ultra short window there that I was hoping to catch the market on a turnaround, on a hiccup with a spike in volatility and a time frame that I saw on my metrics that was possible for us to get. And I wanted to try and catch that with the ProShares ultra short. But that was only a window there. We missed that window. It didn't work our way. So the ProShares ultra short, we should have just exited that because that's a short-term hold. The longer term stuff that you want to hold against, and this is what I want to talk about, though. If you want to have a hedge against the market crumbling, and you want to do something like the SH, the ProShares short S&P, that's fine. You're going to endure a lot of pain before you're eventually right. And a lot of times for me, that pain isn't worth it. I'll take my positions out after a while. If I've got, 10, 15% loss, maybe 20% loss if I really don't like the market. And I like the market because the momentum has been high. But at some point when you're holding that stuff, you can hold it, you can continue to hold it, and eventually you will make your money back on it. But to me, it's a matter of capital in a crazy bull market like this, I don't need to be hedged anymore. We don't need to be hedged anymore. You don't need to be hedged anymore. Time to put hedges on is when we see something happening. And right now, we're talking every day about the irrational exuberance. We're talking about the momentum. We're talking about all the reasons the market is going up and why it's going up. So it's not, I mean, everybody individually, if you don't like the market and you want to put on some hedges, you want to put on some positions, some short type positions, some downdraft positions, go ahead. I'm not inclined to do that. And I was asked a question over the weekend whether or not I actually balance my portfolio in terms of if I see something coming, if I see and I feel this irrational exuberance in this rally, do I position myself to put some shorts on to offset any longs I have? And the answer is no. I only wait to do that when I think there's something going to happen. Now, I could think something could happen tomorrow morning and I could put on some positions if I see something happening. But I don't balance my portfolio unless we're at some interregnum where the market is drifting sideways. Then I might try and create a long short hedge type portfolio because I don't know, I'm not sure where the market's going to go because it might be drifting sideways. In a situation like that, I may do something like that. For the most part, I just won't be in the market. I'll kind of have my stops ready to get out of things if they go against me, but I'm not going to be too active if I don't know which direction the market's going. I like to trade in the direction of the market. And right now, even though I think this is getting a little wild, the direction has been up. So the trend is your friend. You've got to stay with it. Craig's asking, what are your thoughts on SSO? A lot of people are asking me lately about shorting, about taking positions, because I'm not the only one that believes that this rally may have gone too far too fast. I get a lot of questions from friends and business associates and people in the market who, and I had a conversation this weekend with a hedge fund manager who was in disbelief that the market was continuing to do what it's doing, and we discussed whether or not to put hedges on. And my opinion is, if you feel, and if you're managing money and you're managing your own money, if you feel that you're at risk and that the market can turn tail, yes, go ahead and do it. I don't put on something in anticipation of something happening that I don't see happening. I have to see it happening. If I see it happening, and again, it can be just a news item, it can be some metrics that cross my path that I don't like. I can then position myself, and I might be in that position wrong for a couple of days, a couple of weeks, and then I'll get out if it goes back to all well and good and moving higher, which is what we have seen. So, but pretty much without interruption lately. So it's hard to take and put on hedge positions when the market is moving up so strongly. Believe me, I would have lost a lot of money as much as I would have liked to have put on shorts over the last 2 weeks because it just is starting to look silly, except I see the momentum. I see it doesn't matter that it's silly. I would have been on the wrong side, so I didn't put anything on. The SSO position is one position within the window we put on, and got beaten up in there because that window we didn't. What we expected in that window didn't happen. It happened a little bit before I expected the time frame of that window. So, I mean, that's the problem with trying to hedge. If the market is one way, and it's usually, I'd say 95% of the time, the market's one way or the other. And we know it's more bullish than it is bearish, but generally you have a defined trend. There's just maybe 5% of the time the market's flat and just doing nothing, and you're trying to figure out what it's going to do. My saying when there's nothing to do is do nothing. But I know I've gotten a lot of questions about that, and I probably will get a lot more. So if you're looking to hedge, go ahead if you believe that we're near a top or you're going to see some downdraft. I don't see it just yet. It doesn't mean it's not going to happen, and it could happen very quickly, but there'll be enough time. Yes, you may take some losses, you may give up some profits, but when that happens, and it will happen, just don't know when, you're not going to give up everything in a couple of days. So I'm not worried about that. So that's my thought on that. Tom, took my puts on TLT and GLD. Good for you, Tom. Good for you. Yeah, we talked about TLT and GLD and talked about them looking a little toppy because when it was risk on, yeah, maybe we don't need a safe haven. Maybe bonds are going to back up, on and on. So good for you. I'm glad you made some money on that. Terrific. I mean, TLT is an example. If you look at TLT, that's the iShares 20-year Treasury bond ETF. It's just, rolled over and gotten downright ugly as yields have fallen. Yields have increased from 0.65% on the 10-year to, I know this is the 20-year plus, but I'm looking at the 10-year, to 0.93. It's about 0.88, I think, today. We'll take a look and see where their 10-year is, but the yield did come down a little bit from Friday. So a couple more questions, and then we'll close out the market. Michael's asking, SCL on the Toronto. Canadian Oil Services seems very, very frothy compared with U.S. oil services. I don't know SLC. Let me have a quick look. There's just, Michael, there's a lot of stuff that's looking frothy. SLC, I don't know if that's the same stock. This is SLC, that's Superloop. Oh, SCL, sorry. SCL, Stefan Company, it's not coming up. There it is. Well, if it's the same company, Stepan Company, that's also traded on the NYSE and the New York, if that is the same company at 102, that looks very frothy to me. If it's the same stock we're talking about. Yeah, the U.S. stocks are starting, in terms of the energy sector stocks, are starting to get pretty, good, solid bids. And again, that's only because oil has risen, but there a lot remains to be seen whether that demand is going to continue to pick up. Right now, it looks like it's going to. So some of the rises in the energy patch in terms of stock prices are justified so far. We'll see, but those companies have a long way to go to clear out their the debt service. Adrian, others besides SDS and SH that I like. Yeah, there's a bunch of stuff, Adrian, that I like when I think the market's going to go down. But I don't want to get into them now because I'm scared that people are going to do what I would like to do, which is put on positions like that, because to me, this is getting a little bit nutty. And we would have been wrong. We put on that position. We put on those two positions. We were wrong on those two positions. So I'm not going to fight that trend. Again, that was about a window that I saw where the market, the volatility looked like it was going to pick up, looked like we were going to see a hiccup in the market, and maybe, slip, 2, 3, 5% somewhere in there, in which case that would have been a quick hit, especially, on the leveraged, inverse ETF. Didn't happen. So the hiccup we saw was tiny, and then we just blew right past that. So I'm not inclined to put any of those out. Just like last week when I got asked about bankruptcies and companies that I thought were going to go bankrupt and plays for the downside, as long as this irrational exuberance continues to bid stocks higher, it's also bidding bonds higher too. In terms of corporates. Why? Because the Fed's, got the pillar, got everyone's back. It's the Fed put. So I'm not inclined to put those names out there because I know a lot of folks would like to maybe tee some of those up. I just don't want to put them out there and have us get slammed yet. So I think there's plenty of time. I mean, again, I don't know when that time is going to be. I really don't know whether it's going to be a week, month, quarter, 2 quarters. It could actually happen at any time. That's just how nutty we're getting. But be that as it may, we'll cross that bridge when we come to it. Yossi is asking, what percentage do you put for stop losses? Yossi, every stock, every position that I put on, I don't have a set stop, like I use 5% or I do this or I do that. Every position is different because every instrument that I trades differently. Everything has a different profile in terms of its own internal volatility. I don't want to put a stop down, and I try not to put stops down unless I'm away from computer. and I do put a stop sign. I put it below where the expected volatility is, because I know the stock is going to, whatever, whether it's oil or whether it's an energy stock or whether it's Dish or AT&T or SPY, they've all got their own profile in terms of how they trade. I will generally put my stops in where I believe just below the expected volatility. So I'm going to give them room to bounce around and do what they do. And then below a certain level of that volatility, where I expect that range to go, below that, I will generally look for, if I'm long a position, I'll generally look for a support, a level of support. If it's not too much lower. If the next support is a lot lower, I don't want to take that big of a loss. Then I'll arbitrarily try and see if I can maybe come up with some technical aspect in terms of where support might be, where there's a channel line that it might break, whether there's a 50-day, 200-day, 20-day, whatever kind of moving average might break that might cause more selling. Then that's where I'll put my stop. I don't have a hard, fast 10%, 5%. I've taken losses up to 50% and held on and added. So it's different. But when I get out, it's because I want out, period. And so that's really the way to go, is to look at every individual position differently, because every position is different in terms of whether it's a sector or whether, especially if you're using ETFs, what area, what sector, what commodity, whether or gold or whatever it is that whatever instrument is you're trading with your ETF, you need to understand how that trades and put your stops in accordingly. So I know that's a bit complicated and maybe doesn't help you, but try and use technical analysis, look for support levels, and number one, don't take a bigger loss than you're comfortable with. Number one, I don't care what it is. If you're not comfortable with a 3% loss, then don't take a 3% loss. Get out. Whatever your level is, you have to be comfortable with your losses. I mean, 3% obviously is pretty tight, and you're going to get stopped out a lot. But if you get back in and the market keeps going higher, then okay. But you just got to be careful with stops. It's so easy to get taken out of your good positions with stops. That's one of the things that worries me, is that people like to put stops in to protect their profits and or cut their losses. The problem is, I would say 90% of the time, people do not get back in and then miss the ride that they expected prior. So be careful when you get stopped out. Keep an eye on when you want to look for when you want to get back in. That's it. The minute you're stopped out, start thinking, do I want to get back in? Did something happen with this position that I didn't understand? Do I want to get back in? If you really like it and the market just took you out, or because you put a stop down and it got hit because of high frequency traders just whacked your stop, get back in. Get back in. Ken is asking about RTX and BX. Let's start with RTX. Raytheon, got absolutely pounded. Raytheon, everyone is symbols RTX, got absolutely pounded, and the sell-off was extraordinary, and that's really Raytheon and Boeing they were the two stocks most responsible for the losses in the Dow off of the highs from February. So absolutely pounded. Making a decent comeback. It looks like it's broken out above 70. So Raytheon may be worth a play in here. You've got a pretty decent yield at about 2.5%. Raytheon, again, if we're going to get this rotation, Raytheon's going to get one of those stocks that picks up. If there's more saber rattling between the U.S. and China, and anything else happens, then we may see a pickup in Raytheon. But a lot remains to be seen. I would play that one gingerly. But yeah, it's broken out now above 70. Has a bit of a gap there. So it might come down and fill that small gap. But yeah, if you're going to play Raytheon, I would play it from the long side, and just be mindful of cutting your losses if the market turns around, because Raytheon will get hit a little bit on the way down too. But right now, I think it's got some upside. And BX. I've been a fan of Blackstone for a long time. Blackstone Group, everyone, symbol BX. and it's obviously had a very nice bounce up, and it's cranking back up there, heading back towards its highs. It closed at 59.45 today. The 52-week high is 64.97, heading back up there. Blackstone is solid. I think all of the private equity plays, Blackstone, Apollo, Carlyle, KKR, I think they're all going to do well. If the market comes down, the market gets hit, they're going to get hit. If the market gets hit because the economy, everyone recognizes the economy is not done hurting, and we're not on the healing side of everything being nice and cleaned up and tidied up, and Band-Aids are going to stay on. And if we see bad economic numbers and the market reacts negatively to those economic numbers, all of these private equity plays are going to come down, because people are going to think about the portfolio companies that they have and the problems that they're going to have. They're already having problems. The reason that these stocks are bouncing is because people are looking past the portfolio companies' problems, and they're looking to what these companies are going to do with all the busted up companies that they're going to be able to take over and fix and leverage and do all that. So there's going to be a lot of fees to be had. There's going to be a lot of transactions coming down the path. They haven't made many transactions. They haven't made many moves yet, because they're waiting for not the dust to settle. They're waiting for the rest of the basement to collapse in terms of companies. And that's coming. That hasn't happened yet. That's going to happen the next quarter too. All right. So they're waiting for that. And the market's already anticipating that they're going to make a ton of money off of that. But be careful with Blackstone, because, as I said, if the market comes in, all of these stocks are going to come back in pretty hard and fast. So just keep. Otherwise, I like Blackstone. I like them all. I like Apollo. I like Carlyle. They're all good, but KKR, they're all good for the same type of play. So be careful though, because the portfolio companies aren't looking that good. They're going out there, they're raising a lot of debt to support their portfolio companies. A lot of debt, and a lot of it is very leveraged. Okay, so that's why I'm a little apprehensive about just going all in and throwing away the key and not even looking. No, you got to trade those. Just be mindful. Mike says, noticing a lot of gaps in stocks and S&P. Yes, great observation, Mike. You're 100% right. There are a lot of gaps in a lot of stocks. And the interesting thing about those gaps is that I read some numbers over the weekend, which I don't have them right in front of me. I guess so many pieces of paper shuffled all over the place, that let's see if maybe I do have somewhere on here. It was just a crazy number that they didn't flesh out the whole, all the numbers, so they didn't add up to me. But some of the numbers were, I'm trying to find out what they were. Let's see if I can dig them up. Oh, here we go. This is since March 23rd. Now, to me, this is nutty. But again, this piece of analysis that I came across didn't flesh out all the numbers, so it was inadequate. But I'm going to take it for what it was, what I got out of it. Since the March 23 lows, the S&P has gained, on average, and again, it wasn't clear. It just said the S&P had gained 6% from the open to close. In other words, while the market's been open, off the lows, up until present, while the market's open, from 9:30 to 4, the S&P has gained 6%. Between the close at 4 and the open, the market has gained 23%. So obviously those numbers don't add up to the gains that the S&P has actually had. So I wasn't sure how the analysis was run. But what the author is trying to say of this analysis is that the market is gapping up. All right. Once it gaps up during the day, yeah, it's still moving higher, but all of the big moves are coming in the morning, overnight. So in other words, futures are going through the roof overnight in the morning pre-open. And when the market opens, it gaps up. So you're absolutely right. We're seeing all kinds of gaps. We're seeing, obviously, if you're seeing that in indexes, you're seeing it in stocks because stocks make up the indexes. What's happening is those indexes made up of those stocks are gapping. So you get a lot of gaps on a lot of stocks. And that's indicative of just people grabbing stocks, wanting to get in at any cost, just take the next offer, whatever it is. And then there's not a lot of stock offer there. You just take the next offer higher and the stocks go just skyrocket. This is what we've been seeing. This is part of the irrational exuberance that I expressed that I'm starting to see now, because when you see that kind of movement, you scratch your head and say, who's really getting in at reasonable prices? And if the market does sort of soften or turn around, or looks like it's going to turn around, there's a lot of people who paid up for stocks and not a lot of people that incrementally bought all the way up. You bought gap higher, gap higher, gap higher. So you don't have necessarily a lot of cushion, like watch the market ratchet down here, 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 and you're still okay. No, if you bought one of those gaps, you can have a loss very quickly. So I worry about the gaps too. Thanks for bringing that up. But seeing a lot of gaps all over the place. And we know what I think about gaps. They almost always get filled. So that's another worrisome sign. We talked about gaps on the way up. We've talked about it for weeks now, how the markets can go higher because there are resistance levels at certain points. When we get up above certain resistance, I say there's a gap there. The market can just scream higher from there. There's a gap between the next resistance. And then after that resistance, there is no more resistance. There's nothing but thin air. And we've seen that thin air get filled by stocks. So that's what's been happening. I worry about those gaps too. Russ, is the increase in the VIX the indicator to watch now? No, not necessarily. Russ, by the time the VIX increases and, it's come, that's like, I think 25 handle or something like that. But by the time the VIX spikes, the action's already happened. It's fast and furious because people are bidding up those puts. VIX closed at 25.81. So up 5.26%. Now here's the VIX up today, up 5.25% today, when the Dow is up just crazy numbers. So does that make sense? No, it doesn't. It doesn't make any sense. The VIX right now should be around 20. Given the rally we've had. It actually should be a little bit lower. I think it should be probably 18, 19, but of course there's too much fear. This is a loathed, absolutely loathed rally. Everyone thought that the rally from 2009 to 2020 was a hated rally. Well, this makes that look like, almost a beloved, charmed rally. Like, okay, we like that rally. No one liked that rally. No one trusted that rally for years. That was they was the most hated bull market in the history of markets, period. And now we've got, in a tiny 2.5 month crucible of time, the most hated rally ever. Okay. People don't trust it. And we know why. We're talking about that now. We're starting to talk about that. So why is the VIX up when the Dow is up 460 points? Make any sense to anybody? Up 6.8% last week, up 461 points today, another 1.7%, and the VIX is up. All the indexes are up, and the VIX is up. Okay, so no, I don't think the VIX is going to be the arbiter to watch. I think it's really going to be about narratives. It's going to be about what might change in terms of investor sentiment, investor psychology, what the narratives are. And maybe that narrative means consumer confidence. Maybe that narrative will translate quickly to a lack of sales. Maybe that narrative will translate quickly through other different narratives. But I think we'll see it. It's not going to happen overnight. An event can happen overnight to trigger a sell-off for sure. But I think if we see the market start to soften and start to give a little bit, even if we see it happen fairly quickly, we'll have plenty of time to adjust. But I don't think the VIX is the singular. To me, it never is the singular. By the time the VIX hits, 30, 40, 50, the damage has already been done. Okay, so if we start to watch the VIX tick up, it's also given a lot of head fakes. So that's something we're going to keep an eye on, but it's not the be-all, end-all to me. Tommy, do I use alerts? No, I don't, Tommy. I really should, but most of the time I don't have a lot of positions on. I know what my positions are, and I kind of know what's going on with them. So it's not as if I have the old days. I would have. I couldn't even tell you how many positions I'd have on. Sometimes 100 or more positions on. And that was, stocks and options positions and offsets and all kinds of other stuff. No, I didn't even have. I had clerks then and kept tabs of that stuff. But no, I don't use alerts. You should. Everyone should use alerts. I'm old school like that. So hope that helps you. But use alerts. Tom's asking, what do you think of DGLY on its move up? Digital Alley Inc. Wow. What do I think? I don't know what it does. All I'll say, it's crazy. That's a crazy move. I'll have to take a look at that, and we'll talk about it tomorrow. But that kind of thing scares me. I don't know what it is, up 96% today. So whatever it is, obviously, there was a heck of a lot of news or good news or something, because it also moved up on a huge amount of volume, which it looks like it probably never has. But we're looking at almost 100 million shares today. So I'm going to take a look at that. Thanks for bringing it up. GGLY. Wow, that's a crazy move. All right, so thanks for bringing that up. Sorry, I don't have an answer for you right now, but we'll take a look at it. Peter's asking, my CIT again, 11.8% of financials still running. Yes, ride the financials, ride CIT. Why? Because these are the groups that everybody's like moving into now. CIT has a way to go. CIT broke out nicely, and we have that gap there, which is a little worrisome if we back down. But right now, I would say ride it. You have up almost 12% today. Just I'd be mindful of it turning around at some point if the market gives up. But the financials look strong simply because they're getting rotated into. All of the financials, I mean, they have been really the leadership in lieu of, even though the big mega cap tech stocks are doing just fine, thank you. The banks, the financials have been doing better in percentage terms, but you're starting to see gaps. I'm looking at Bank of America. There's a big gap there. It broke out nicely, but then there's a gap there. So can they go higher? Yes, they can. Do you want to be mindful of the gaps? Yes, you should. Again, the financials, just ride them, but take your profits and take them quickly, because you can always get back in. But if the market's going to turn, again, I don't see it turning just yet or now, or maybe next week or two or month or three. I don't know. Ride these. Keep riding them. When you got a trend is your friend. Ride them. Don't be greedy. Yeah, good for you, Peter, on your CIT. Excellent. Tommy's asking, don't know if you can answer this here. Is it possible to scan or search stocks, ETFs for gaps? I use Thinkorswim. I don't know. It's a good question. I'll try and look at bar charts and my interactive and some of the other stuff I use. It's a good question. Not that I would want to necessarily trade every gap, Tommy, but that's a pretty cool idea, just to look at them. And if you see some extraordinary gaps, that might be something to take a look at, especially because we're moving higher at this crazy rate. Some of those gaps might be the stocks you want to look at to catch on the downdraft. So pretty cool idea. I like it. Frank's asking, what is the best gambling, travel, leisure stock or ETF? That's a good question. I don't know. I really don't know. I'm looking at just a handful, like a Marriott and a Hyatt, and I'm going to look at some of yours. I don't have any. I mean, really, probably the crazy ones would be the gaming stocks like MGM. Again, these stocks have already had really good moves, and MGM today up, almost 9.3%. So let's see. You're looking at BETZ. Let's take a look at that. BETZ, everyone, is Round Hill Sports Betting and Gaming. Looks like it's a newcomer and not a lot of decent volume today, but don't see a lot of action there. So there's not enough history for me to call that one. It looks like it trades in some pretty big moves. But again, not enough history for me to comment on that. ESPO, ESPO, and BYD. ESPO, ESPO is a symbol, and it's the VanEck Vectors video gaming. Again, through the roof. This is done really well. It's like, to me, these are the coronavirus lockdown, stay at home stocks that have done really well. Are they going to continue to do well? I don't know. The video gaming, sport, Activision, Zoom, you look at all of those stocks, and you want them to go higher because you own them. But again, they could look a little toppy, and I'd have to do some analysis on the PE on this and see what's in it. But yeah, I think that there's a lot of room to grow in that business. The gaming business is going to be popular for a while. I know some games get hot and then turn cold, but I would just be careful on these that have had that great run, that you make sure you take some profits if they start to tumble back. Boyd Gaming is another one you looked at, symbol BYD. Boyd Gaming looks better than the VanEck to me. It looks like the Boyd's got a little more room to move. VanEck looks a little bit frothy to me. But again, if you're riding them and you got profits in them, I would hang on. I would just use your mental stops or stop, whatever you prefer, and take your profits. Again, if these stocks come down and you take your profits, you can always get back in lower. Okay, if you get stopped out and they go back up, you could always get back in when they're going up. You should like and want to buy stocks that go up. Okay, so if you're buying them because they're going up, as they're going up, that's fine too. So I just see a lot of folks leave a lot of money on the table and lose a lot of money because in the end they just don't take their profits. They're in it for the long run. That's fine, except if you can take profits, yes, it's timing. Yes, I know you're not supposed to time. I time, you time, we should time. Take profits. Be careful out there, because if you leave your profits on the table, it may take years to get them back. So hopefully that helped you out, Frank. Ken Chambers is asking, it's a very confusing market. Shorts do not seem to work for me. Ken, if you're shorting, we shorted a bunch of stuff early on when the market fell, and we knocked it out of the park, continued to short, put on some put positions, got our heads handed to us because obviously the market turned and we had our positions on from before that were making money. Then all of a sudden when the market turned, we started losing money on them instead of taking them off. Figured, okay, the market's going to do this anyway, and then it never looked back. So I'm not shorting anything right now because you're trying to catch a falling knife. That's it. You're throwing the knife yourself. It's too tough right now because the market wants to go up. Doesn't matter. It's irrational. It doesn't matter. Nothing matters. And what if it did? Okay. The trend is your friend. Go with it. Don't fight it. There'll be plenty of time to make money on the downside, right? I know it's confusing. Can I agree with you? I understand it and you understand it, but emotionally and logically, it's a head scratcher. Russ is telling us bar charts has a menu item for gap up and gap down. Terrific. Thanks, Russ. Another reason I guess I like bar charts. I will take a look at that. I'm going to look at that tonight. Thanks. Just something I hadn't thought about. What a terrific idea. Really appreciate that. And thank you, Russ, for enlightening us. Everybody, bar charts, barchart.com, barchartsingular.com. Great site. And as Russ is pointing out, they also have some information on gaps up and down, which again, we might be using. So we'll take a look at that. Maybe we can find some fun stuff to trade, everybody. That's very cool. Sufi, 5G stocks, cannabis stocks. Haven't gotten you those yet, Sufi. I'm gonna call my cannabis guy. No, not that guy. I'll call my cannabis guy next couple of days. He's out on the West Coast. That's his beat. He knows cannabis stocks. I really don't. And 5G, I'll do some homework myself. But really, the 5G, when I looked at it, it's really the big players. But I'll come up with some names for you on the 5G. Michael, can you keep us up to date on the confluence that led you to think about the May 20th possible turn? Oh, excuse me. That's what happens when you talk too much. Excuse me. Plus the allergies. Complicated bunch of windows that look into metrics with algorithms and all kinds of stuff. It was a window that popped up and it passed. And I think it was maybe a little bit ahead, and it certainly wasn't the window that I expected. We got that little tiny bit of a blip down prior to the 20th, and that might have been what the metrics were showing me. And then, of course, the market just tromped all over that and ran over it literally and squashed it. So that's gone. I don't have anything else showing up like that now. To the contrary, I'm getting a lot of bullish signals, which also scares me because the algos and all the stuff are pointing to bullish. When everything starts to point in that direction, you start to scratch your head and go, it's just, that defies logic, but go with it. So hopefully that helps you there. Sergio, at what price do you like Microsoft to continue add to your long-term position? Any price. Any price, because Microsoft is still one of my favorite companies, still one of, I think, the best run companies out there, period. Just the whole ecosystem of products and software, hardware, it's got it all going on. Microsoft Teams is going to eclipse Zoom at some point. Zoom's had a really great run. I think it can continue to go higher. But Zoom is getting frothy. Microsoft's Teams product, its video conferencing product, is as good as Zoom. It just hasn't been used as much, but they're advertising a lot now, and it's going to get a lot of pickup. I really think that you're safe with Microsoft at any price. I mean, right now, it looks like it could break out. I know that sounds crazy, but if the market's going to go higher, the market could go higher for a bunch of quarters. It could go higher for another year. I don't think it will. I think we got the election coming up. I think that's going to be a big problem for the market. So I'm worried going into the rest of the summer. I'm worried about the next earnings period. I'm worrying about the market flattening out. I'm worrying about exhaustion in terms of the buyers throwing their hands up, not knowing what else to buy as they see earnings come out and the stocks that they bought don't justify, the prices aren't justified, or PEs aren't justified, evaluations aren't justified by the lack of revenues, the lack of earnings. That's what I'm afraid of in the back half of the summer. Then we're heading into the election. Things are going to get super dicey there. I think volatility is going to pick up, and it's going to be really choppy, I believe. Into that, Microsoft selling down is a buying opportunity. Is it high here? Yes, it's high. Is its justification, the justification of a PE of 31 makes sense for Microsoft? That's high. That's high. So as much as I love the stock, if you want to buy in here, make sure you want to buy lower and add lower. I certainly wouldn't go all in here. Again, I've been wrong about the market turning around because it defies logic, but at some point I do believe it's going to come back. And I'm not saying we're going to see a crash, but I do believe that's entirely possible. I brought up the tech wreck before and what happened, and I gave you some of the metrics in terms of real irrational exuberance. But don't forget, it took 3 years for the tech wreck to occur after Alan Greenspan made his irrational exuberance comment in 96. The market didn't crash till 2000. So can we go a lot higher? Yes. Do I like Microsoft? Yes. If you own it a lot lower, be real happy. If you're buying it up here, I would rather probably sell puts up here if I don't own it. If I wanted to add to my position, I'd probably rather sell puts here on down days. Microsoft, has a down day, then I would look to sell some puts. And I would probably go out a couple months And if the stock comes down and you get a sign, meaning you have to buy those puts at a lower price, buy the stock at a lower price, you wanted to buy at a lower price anyway. If the stock does nothing, you keep the premium that you collect for selling the puts. That's probably how I would play Microsoft right now if I didn't own it and I wanted to acquire some Microsoft. That's what I would do. I would make money selling puts. If the stock goes up, you keep the money you get for selling the puts. All right. That's what I think the way to play Microsoft right now, because PE's 31. That's rich even for Microsoft. So hopefully that helps you out, Sergio. Tom is asking, which moving averages do you use most? I use pretty much the 200, the 50, and the 20. Sometimes I use a 7. I use a 721 crossover sometimes. But generally, I like to watch pretty much the stuff that other traders are watching. Okay. The reason the technical analysis can be so effective is because so many people are viewing the same thing through the same prism. Okay. So that really helps me understand what other traders are thinking, what the psychology is out there, because we can see it in the charts. We can see it in the technical patterns. So that's why I like a 200-day moving. That's why I like a 50-day moving. And that's why I like 20. The 7 and the 21, that's more for shorter term trading that I keep an eye on. But so those three really important to me. And if I have to pick two, it would be the 50 and the 200. Very helpful to use those. Sufi's asking how to ride Oxy and what strike to get in at. So let's take a look at Oxy. Okay, Oxy, OXY symbol, Occidental Petroleum. Wow, just had a stellar move up. I'd have to guess there's a lot of short covering there. Sufi, let me just have a quick look at the short position. Again, everybody, when I'm looking at some of this stuff online, I'm going to places where you can look to, so you can follow along. I'm going to Yahoo Finance. I'm going to pull up OXY, and I'm going to go to statistics. Of course, my computers are slow because my Wi-Fi is awful. If anybody out there has anything that boosts their Wi-Fi, I'm going to have to get a cable and see if I can run direct cable to my boxes. But I've seen advertisements for some of these little devices that boost your Wi-Fi from outside inside, because supposedly it's throttled that way. And some of these devices I've seen advertised, I'm thinking about picking up one or two and see how they work. If anybody has any heads up on any of those devices and how they operate, if they work, I'd love to hear it. And we'd all probably love to hear it because everyone's probably got some Wi-Fi issues. Still waiting on Oxy. Heck of a move, that's for sure, today. And usually that's indicative of some kind of short covering. So you don't see stock move 17% unless there's some heavy duty short covering. So I'm up there, I pulled up Oxy, and I'm going to the statistics page on Yahoo Finance. And I'm going to go just have a real quick look at the short ratio, 9.3%. There you go. So that's pretty heavy for Occidental Petroleum. 9+% of the floating stock had been shorted. There's your answer as to what that pop is. So we're seeing some covering there. Now you've seen that it's happened over the last couple of days. Gapped up on Friday, gapped up again today. That's a dyed in the wool short covering rally. Has it broken out? Yes. Now it's looking like it's going to try and fill that gap that it made on the way down and try and get to really probably like maybe 26 thereabouts and fill that gap. I'd be leery of that. Unless we can see WTI head up to 40 and stay north of 40, I'd be apprehensive about Oxy up here making a move like that. So hopefully that helps you there. If you own it, then great, but take your profits if you start to see it slip back down, especially if you start to see oil slip down. Tom's asking, I have You have an iron condor on, Mike. You like those iron condors, don't you? Good for you. They're top and look to be moving sideways. It's actually a good position to put on, Tom, right there. It does look like it's going to go a little sideways in here. I like an iron condor there. Good for you. Smart move. Tom's also says, are you on a 5G network? You need to update your router and modem. They just updated it, Tom. They just brought new ones in for me, so that I got whatever Optimum has. That's their most current top of the line, whatever it is. So I'm just looking for something else to do. And I talked about getting a line in here, and it's ridiculous how long it's going to take. Tommy, you don't use a booster unless you are far from your router. No, I'm not far from the router. I'm 2 arms length away from it. That's it. And there's no walls between them. And I actually angled it out, and it's facing my computers. It's literally it's right here. But thanks for that heads up. All right, everybody, thank you for letting me keep you. Again, 450. You guys are great. And have a good evening all. And I'll look up some of this stuff tomorrow. We'll work on some cannabis stocks for you, Sufi, and 5G for everybody else. So good night, everyone. Be safe out there. Cheers. Thanks for being with me.